Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Pearson's Federal Taxation 2024, Chapter 1, which covers an introduction to taxation. So some of the learning objectives from Chapter 1 include discuss the history of taxation in the United States, describe the three types of tax rate structures, describe the various types of taxes, discuss the criteria for a good tax structure, the objectives of the federal income tax law and recent tax reform proposals, describe the tax entities in the federal income tax system, identify the various tax law sources and understand their implications for tax practice, describe the legislative process for the enactment of the tax law, describe the administrative procedures under the tax law, describe the components of a tax practice, and lastly, to understand the importance of computer applications in taxation. So as it relates to the history of taxation in the United States, the federal income tax is the dominant form of taxation in the US. In addition, some states and some cities and counties, they also impose an income tax. So prior to 1913, in 1913, that's essentially when the 16th Amendment was ratified, and the 16th Amendment in the Constitution of the United States of America, it's only one line. However, it essentially permits the passage of a federal income tax law. Prior to 1913, the federal government, they relied predominantly on custom duties and excise taxes in order to finance their operations. The first federal income tax on individuals was enacted in 1861, and this was to finance the Civil War. But after the Civil War ended, then they essentially, repealed the income tax. And 33 years later, in 1894, the federal income tax was reinstated. However, there were some challenges. Reason being, the tax was essentially apportioned among the states based on their population. So having that type of tax system, it made it very difficult because an individual would pay taxes based on their state of residence. So it made it very impractical and difficult to administer. So because of this challenge, in 1895, the Supreme Court ruled that the tax was in violation of the US Constitution. So just keep in mind, taxpaying entities, as we'll learn a little later, there's taxpayers, individuals, and then there's also businesses. So in 1895, when the Supreme Court ruled that the tax was in violation of the US Constitution, this related to individual taxation. Businesses were still taxed. So in order to make it, applicable per law to tax individuals, they had to amend the US Constitution. And as mentioned earlier, this was accomplished by the 16th Amendment, which was ratified in 1913. All right, so it is an extraordinarily important amendment, and it's only one sentence. So the 16th Amendment states that Congress shall have the power to lay and collect taxes on income from whatever source derived without apportionment among the several states and without regard to any census or enumeration. So for those of you who decide you want to have a career in taxation, you'll realize that there are some taxpayers who are not subjected to state taxes. Everyone is subjected to federal taxes. However, not all persons are subjected to state taxes. For example, if you have a client that lives in New York, that client, depending on where in New York they live, they might be subjected to New York state taxes, or they might be subjected to both New York state and New York City taxes, versus a client who lives in, let's say, Florida. That individual would only be subjected to federal taxes, but they are not subjected to state taxes. So this essentially, in effect, is what the 16th Amendment allowed. Everyone is subjected to taxes at the federal level, and state taxes are essentially subjected to which state you are a resident. So here we see the tax laws were codified into the Internal Revenue Code of 1939, 1954, 1986, and 2017. So in 1939, less than 6% of US citizens were taxed. In 1974, more than 74% of US citizens were taxed, and tax revenues, they're essentially used to fund government operations. As it relates to the revenue sources, so as mentioned earlier, the largest source of federal revenues is individual income taxes. Some other major revenue sources includes Social Security. These are FICA taxes, as well as corporate income taxes. So here we see for individual taxes, as of 2022, individual income taxes make up about 54%. Social Security makes up about 30%. Corporate taxes makes up about 9%, and other taxes make up about 7%. So the types of tax rate structures. So virtually all tax structures are comprised of two basic parts. We have what's called the tax base, and we have what's called the tax rate. So the tax base is the amount of which the tax rate is applied to determine the tax due. So for example, an individual's tax base as it relates to income taxes is their taxable income. And as we move on, you will learn a bit more of how the taxable income is actually calculated. Just because a person earns $70,000 during a year, it does not mean that the entire $70,000 is taxable. There are some adjustments to income, some deductions that are allowed to be taken that ultimately determines what that individual's taxable income might be. So similarly, the tax base for property tax, let's say, is generally the fair market value of that property that's subjected to the tax. And the tax rate is basically just the percentage rate that's applied to that base. So as it applies to tax rates, there are these three structures. It can either be what's called progressive, regressive, or proportional. So a progressive rate structure is one where the rate of tax increases as the tax base increases. So the most relevant is essentially individual income taxes. Unfortunately, the more income you make, it's the more taxes that you are subjected to. So in such case, with the progressive tax rate, again, just keep in mind and just think of the terminology. Progressive means that you are increasing at a specific rate. So just keep that in mind. Progressive means that at an incremental rate, the more income that you earn, the more it is being subjected to taxes. Next, we have what's called regressive taxes. So with the regressive tax, the rate decreases with an increase in the tax base. So regressive taxes is not necessarily consistent with the fairness of the income tax in the United States of America, but one key example of a regressive tax is the Social Security. So FICA tax is regressive because there's a fixed rate of 6.2% for OASDI. And OASDI, that is for Old Age Survivors Disability Insurance. So that's basically Social Security. So there's a fixed rate of 6.2%, and this applies to both the employer and the employee. And each year, there is an increase for inflation to a specific amount. So once an individual pays that maximum amount of Social Security, that 6.2%, then they no longer need to pay anymore. So that is an example of a regressive tax. And lastly, we have a proportional tax. So a proportional tax rate, sometimes it's referred to as a flat tax. So this is one where the rate of tax is the same for all taxpayers with no regard to their level of their tax base. So a great example of this would be like state and local sales tax, personal property taxes, custom duties, excise taxes. So it doesn't matter. Simple example, if you go to the corner store or if you go shopping, there's a specific tax rate per state. In New York, it's 8.875%. So if you go into the store, we purchase the same things. It doesn't necessarily matter where we live or how much income we earn. That flat state sales tax is subjected to each person. So sales tax can be an example of a flat tax rate. So as it relates to the same conversation, tax rate structures, we have what's called the marginal rate, we have the average rate, and we have effective tax rates. So a taxpayer's marginal tax rate, that is the tax rate applied to an incremental amount of taxable income that is added to the tax base. So the marginal tax rate, this concept is useful for planning because it measures the tax effect of a proposed transaction. So again, let's say an individual in prior years, their income was around $30,000. And this year they are considering getting a new job. And as they get this new job, they are going to be entering into a new tax bracket. So because they are entering into this new tax bracket, that determines their marginal tax. For every additional dollar that they earn, that additional money that is put into another tax bracket, that essentially has an impact on how much taxes they are going to owe. Next, we have the average tax rate. So while the marginal tax rate measures the tax rate that's applicable to the next dollar of income or deduction for a taxpayer, there's two other tax rates that are primarily used by policymakers. And here we see one is the average tax rate and the other is the effective tax rate. So the average tax rate, that is computed by dividing the total tax liability by the amount of taxable income. So this essentially represents the average rate of tax for each dollar of a person's taxable income. So let's say, for example, if a single taxpayer had taxable income of $500,000 in 2023, so let's say that $500,000, that was their taxable income, and they had a total tax liability of $146,895. $146,895 divided by 500,000. So in such case, their average tax rate is 29.4%. So it is the tax liability divided by the taxable income. So their marginal tax rate would be 35% based on their income. However, based on the tax liability divided by the taxable income, their average tax rate is 29.4 rounded. Next, we have what's called the effective tax rate. And this is the total tax liability divided by their total economic income. So as it relates to total economic income, this includes all types of economic income that a taxpayer has for the year. So economic income, as you would assume, it's much broader than taxable income. And it includes most types of excludable income. So if there's tax-exempt bond interest, personal business deductions that are not allowed. So just keep in mind, economic income is not statutorily defined, and sometimes experts, they disagree on a precise calculation on how that is actually factored in. So as we'll discuss in later chapters, the federal income tax, as we pointed out, it's imposed on all taxpayers. States might differ, but at the very minimum, all individuals, this includes individuals, corporations, estates, and trusts, they are subjected to federal taxes. So in general, taxable income is computed as follows. We start off with total income, and this is income from whatever source derived. From there, we subtract exclusions, and exclusions are specifically defined items such as tax-exempt bond interest. This would also include death benefits in the event that a person passed away. Sometimes life insurance proceeds are not taxed. So as we'll learn in chapter 4 essentially deals with gross income exclusions, the specific provisions in tax law that lets you know which items are not included in income. From there, we calculate the gross income. Then we subtract deductions, if any. This includes business expenses and itemized deductions. From there, we get taxable income, and we multiply it by the applicable tax rate. We consider any income tax before credits. We subtract any tax credits, and from there, we determine the tax liability. The last step is to subtract any prepayments. If you are an employee and you work a job, then the job is withholding and remitting federal taxes on your behalf. if you are a self-employed individual, a business owner, if you pay estimated taxes, or in the prior year, if you were supposed to receive a refund and you decided to apply it to the prior year. These are all examples of prepayments. And based on this calculation, that determines if a taxpayer has a balance due or a refund. So for each different type of taxpayer, again, there's individuals, there's corporations, estates, trusts, they compute their taxable income in a slightly different manner, but all use the general framework that is up above. All right, so here's some other types of taxes. So in addition to federal income taxes, there are several states and local jurisdictions that impose income taxes on individuals and businesses. So these state and local taxes, they've gradually increased over the year, and they currently represent a significant source of revenue for state and local governments. But more taxes, obviously, it represents a significant tax burden on taxpayers. So state and local income taxes, they vary greatly in both form and rates. There's 8 states that do not impose an individual income tax. So in some instances, state income taxes are considered progressive, and it's based on an individual's federal adjusted gross income, AGI, and sometimes there's some adjustments. All right, so some other types of taxes here we see, we have state and local taxes, we have estate taxes, gift taxes, property taxes, federal excise taxes, sales tax, employment taxes, as well as unemployment tax. So oftentimes you hear a lot of people saying, why do we have to pay taxes anyway? It's unconstitutional, but as we've learned, the 16th Amendment essentially governs and permits the passage of federal income tax laws. So since there's no way to get around it, we want to ensure that there's a good tax structure. We want to ensure that the objectives of the federal income tax law, that it is fair. So establishing criteria for a good tax structure was first attempted in 1776 by an economist named Adam Smith. So Smith had these 4 canons of taxation. There needs to be equity, there needs to be certainty, there needs to be convenience, and economy. So generally when politicians and those who are involved in making tax laws, when tax policy issues are discussed, they look at these 4 canons as discussed here. And some have added a 5th canon of simplicity, because sometimes, the tax law can be so complex, but you want to ensure that persons who are not specializing in taxation, that they can understand the impact that tax would have. So here we have these 5 criteria, right? So we start off with equity, and a rather obvious criteria for a good tax structure is that it's equitable, or simply stated that it is fair to taxpayers. But as it relates to equity or fairness, sometimes it can be subjective, right? It ultimately depends on who you're speaking to, whether or not they will agree that paying taxes are fair or equitable. So unfortunately, fairness oftentimes is seen as relative in nature, and it can be extremely difficult to measure. So a great example would be, let's just say, the deductibility of mortgage interest, right? It seems to be a fair provision for taxpayers. There's a lot of nuance because it depends on if you itemize deductions and things of that nature. But for mortgage interest, an individual who's a homeowner and they meet certain thresholds, they can deduct their mortgage interest. But what about someone who doesn't own a home and they live in a rental apartment? The individual, unfortunately, is not allowed to deduct any portion of the rent paid. So in such case, a person who is a renter might deem the deductibility of mortgage interest unfair because they don't have that privilege to take advantage of that tax law. Next, we have what's called certainty. So a certain tax, this ensures that there's a stable source of government operating revenues. And 2, it provides taxpayers with some degree of predictability concerning the amount of their annual tax liability. So a tax that is simple to understand and administer provides certainty for taxpayers. So for a very long time, even till this day, a lot of times persons, they criticize the tax law because they see it as very overly complex and very difficult to administer. So unfortunately, fortunately, the tax system, they've tried to make some attempts to provide certainty for taxpayers. So they have things like advanced rulings, which provide some insurance concerning some of the tax consequences of a potential decision that a taxpayer might make and things of that nature. Next canon, we have convenience. So a tax law should be easily accessed, collected, or administered. So taxpayers should not be overly burdened with the maintenance of records and compliance considerations as it relates to preparing their tax return, paying their taxes, keeping records, and things of that nature. So as it relates to the individual income tax in the United States, unfortunately, some persons don't necessarily see it as convenient, right? Reason being, because each year you have to prepare your income taxes, right? So in such case, you need to keep good records of those things. They generally recommend keeping at least 3 years prior to where we currently are now. There's a lot of cloud-based things. So a lot of companies, they would upload your information electronically. But if we think, of several years back, individuals would have stacks of papers that they need to keep handy. But now, since we are living in a cloud-based age where there's paperless things taking place, I think that eventually there would be more convenience as it relates to the U.S. income tax system. Next, we have autonomy. So an economical tax structure should require only minimal compliance and administrative costs. So the IRS collection costs amounting to less than 0.5% of revenue, it's minimal relative to the total collections of revenue from the federal income tax, right? So it's just something to keep in mind. Is it economical for the IRS? And lastly, we have simplicity. One of the important measures for any tax system is its simplicity, and that it's not, too complex, but not too simple at the same time. So taxpayers, they should be able to understand and comply with any tax system within reasonable boundaries. So a great example of simplicity is sales tax, right? As mentioned earlier, in New York, the sales tax is 8.875%. So if you go into a store and you are going to purchase something, okay, I'm purchasing $5 worth of goods. The sales tax is 8.875%. So therefore, you multiply the $5 by 8.875%, and you know exactly how much you will need. So here we have the objectives of the federal income tax law. So the primary objective of the federal income tax law is to raise revenues for government operations. So over the years, the federal government, they essentially broaden the use of the tax laws in order to accomplish various economic and social policy objectives. But first things first, we want to ensure that it is economical. What are the economic objectives? So the federal income tax law is used as a fiscal policy to stimulate private investment. It helps to reduce unemployment and helps to mitigate the effects of inflation on the economy. It also helps to promote certain activities. So the federal income tax law also helps, or attempts rather, to stimulate and encourage certain activities as it relates to specialized industries and small businesses. So one example, as it relates to research activities, and permits write-offs of certain expenses. Another one would essentially be ensuring that persons are prepared for retirement, is that they have deferral when you make investments into your 401k, right? You're preparing for retirement, so you can essentially defer taxes on that income, or you can prepay taxes on certain investments, and then you would pay the taxes now, and when you withdraw the funds. There's also, again, as it relates to retirement, they want to ensure that persons are saving adequately for retirement. They have a 10% penalty if you withdraw funds from your retirement early. So a person now has to really think, do I really need this money? Imagine if, they didn't have this 10% penalty. I'm sure persons would probably just go take the money, pay the income tax, but because of this additional, so sometimes the tax laws, they can either encourage an activity or they can deter a person from taking on a certain activity. Next, we have social objectives. So the tax law attempts to encourage or discourage certain socially desirable or undesirable activities as mentioned just now. So again, you have that social objective. You want to invest money for retirement, so there's an incentive to do such, or you want to be able to prevent persons from taking money from their retirement prematurely, so they have certain provisions in place. All right. And then obviously tax reform, that happens when the taxes essentially are administered. So the federal income tax law, as we know, levies taxes on taxpayers. However, not all entities that file income tax returns actually pay income taxes. So for example, we have what's called tax-paying entities, and we have what's called flow-through entities. Flow-through entities are often referred to as pass-through entities. So the various entities in the federal income tax system may be classified into two general categories. We have tax-paying entities and flow-through entities. Tax-paying entities generally are required to pay income taxes on their taxable income, and then flow-through, aka pass-through entities, on the other hand, they generally don't pay any income taxes, but they merely pass through, they flow through the income onto a tax-paying entity. So the major entities in each category is as follows. So we have tax-paying entities, which comprises of individuals and C corporations. C corporations are governed by subchapter C of the Internal Revenue Code. Our flow-through entities are sole proprietorships, partnerships, S corporations, LLCs or LLPs. LLC stands for Limited Liability Company, and LLP stands for Limited Liability Partnership. And then we also have trusts. So as it relates to our tax-paying entities, individual taxpayers are the principal tax-paying entity in the federal income tax system. So as we saw in the previous slide, they make up 54% of total federal revenues. So individuals, they pay income taxes on all gross income minus any allowable deductions. So gross income minus allowable deductions, that's referred to as taxable income. So gross income for an individual that's subjected to taxation is broadly classified into three categories. So as we see here, earned income, investment income, and flow-through income. So earned income are from sources such as salaries, wages, any business income, and retirement income. So as it relates to earned income, you need to work. You are actively doing something to earn that income. You go to your job each day, Monday through Friday from 9 to 5, sometimes more hours. You have a business, you are actively working in your business. So you're earning that income because you're actively working. Next, we have investment income, and this would be considered like passive income. So this is like interest income, dividends, capital gains, rents, and royalties. So when it comes to dividends, if you invest money into a stock, or if you have bonds or something of that nature, that is passive income. You don't need to do anything active. The main thing that you're doing is that you are investing your money, or you are lending money, and from there, you are essentially passively earning income. There's not much that you need to do. Same thing as it relates to rents. You have a rental property, the individual lives there, there's not much that you need to do. You don't need to go to the rental property every day to fix things and things of that nature. The structure in and of itself, the property, is what earns the income. Next, we have flow-through income. And flow-through income, as we just learned, is income from partnerships, limited liability companies, S corporations, estates and trusts, and limited liability partnerships. So as it relates to determining income for an individual, one of the most important things is being able to determine between the for AGI and from AGI. So for AGI, these are some examples: business deductions, moving expenses, IRAs, and self-employed health insurance. So for AGI, you are essentially deducting an amount to determine what your AGI is. And then from there, in order to determine what your taxable income is, those are your from AGI deductions. And that is the greater of your itemized deductions or standard deductions. So as of right now, you go through this probably won't make any sense. But as we start to go through the additional chapters through 2 and the rest of the chapters, then it will start to make more sense. This is theoretical, but when you start to apply this information practically, it starts to make more sense. But just keep that in mind for AGI versus from AGI. For AGI helps you to determine what the adjusted gross income is. From AGI helps you to determine what your taxable income is. So as it relates to tax-paying entities, we follow up with corporations. Corporations, they only account for 9% of US tax revenues. C corporations, many times referred to as regular corporations, as we previously learned, these are also referred to as tax-paying entities. So C corporations, unfortunately, those who have been setting them up, they've been steadily declining over the past few years. And one of the biggest disadvantages of a C corporation is that they are subjected to double taxation. So what this simply means with double taxation is that, again, the C corporation is a tax-paying entity. So the C corporation pays income taxes on their taxable income, and then the shareholders, they also have to pay income tax on any dividends that they receive from the corporation or any gain from selling their stock in the corporation. So that is one of the biggest disadvantages of a C corporation. The C corporation pays taxes, and then the shareholders pay tax again at the shareholder level. So the first level of tax, it may be mitigating by paying shareholder employee salaries and bonuses, but it can't be subjected to the IRS deciding to probe. The second level of tax may be mitigated. There's something called DRD. This is the dividends received deduction, whereby they get a reduced rate for the dividends that are received. So they get to take a deduction. These things as it relates to corporations and S corporations, in partnerships, you would learn more about that in Federal Income Tax Law 2, which deals with business entities. And as it relates to the tax calculation for corporations, it's fairly similar. Start off with total income, you subtract any exclusions. From there, you get gross income. From there, you subtract any business deductions, and then you get taxable income. So for corporations, as of right now, due to the Tax Cuts and Jobs Act, TCJA, corporations, they used to be taxed at a progressive tax rate, much like individuals. The more income a corporation makes, the more taxes they need to pay. However, based on the Tax Cuts and Jobs Act, corporations are subjected to a flat 21% rate. So corporations are subjected to a proportional flat tax rate of 21%. It doesn't matter if they make $1 million, if they only make 1,000, 10,000, there's a flat 21% tax rate applied to their taxable income for corporations. As it relates to flow-through entities, the simplest form of a flow-through entity is a sole proprietorship. There's no formal requirements to set up this entity. As it relates to a sole proprietor, they essentially just report their income earned on Schedule C, C as in cat, of Form 1040. So when it comes to the income of a sole proprietorship, it merely flows to the proprietor's individual tax return. The net income is subjected to income tax only once at the individual level, but it's also subjected to self-employment taxes, so Social Security and Medicare taxes. So flow-through entities, the other entities are partnerships, are LLCs, are LLPs, and S corporations. They have the major advantage of being subjected to only one level of taxation. So all of these entities, they file a tax return, but the entity itself does not pay any income taxes. So for the sole proprietor, we file Schedule C as in cat. S corporations file Form 1120S as in Sam. LLCs, if it is a single member LLC, then they file a Schedule C. They're taxed the same way as a sole proprietor. If it is a multi-member LLC, which means there's more than one owner, they file Form 1065. And for a limited liability partnership, they also file Form 1065. So as mentioned, the flow-through entities are not taxed on an entity level. Instead, the income is allocated to the shareholder, partner, member, and taxed on that level. To prevent double taxation of the same income, the taxpayer's basis in the entity must be maintained. And again, referring back to the Tax Cuts and Jobs Act, flow-through entities may deduct 20% of qualified business income. This is also referred to as QBI, and QBI relates to net income from business activities. However, it does not include investment income, which is the passive income such as interest, dividends, etc. So as it relates to partnerships, as mentioned, it is very important to keep track of the basis. So a partnership is the classic flow-through entity. It's been around the longest. The Internal Revenue Code defines a partnership as a syndicate, a group, pool, joint venture, or other incorporated organization that carries on any business operation or venture. So simply stated, if two or more individuals, corporations, trusts, or estates decide they want to start a business, then the business venture can be classified as a partnership. So unlike a corporation, which has to file incorporation documents with the state, partnerships, they do not require any legal documentation. But, it's very smart if you are starting a partnership to have some legal documentation in place. Think of it like a marriage, the same thing. Two persons are coming together, joining things that they have. You want to have something in black and white. So as it relates to the partnership, you add the partner's contribution. This could either be the cash or property that they invest and their share of partnership debt. And you could either add or subtract the income or increase in debt, and then you will subtract the losses or the debt payoff, and that ultimately determines the partner's basis. So this is just, going over some of the information. Partnership, two or more individuals. A partner can be an individual, a corporation, a trust, or an estate. Partnerships file an annual return as mentioned, Form 1065, and the entity's income and deductions flow through to the partners on what's called Form K1. The net income is not taxed at the partnership level. It is only taxed at the partner level. So again, the entity, the business, does not pay any taxes. The income and deductions pass through to the partners, and therefore they pick up and report the income and pay taxes at their personal level. So this is just an example. Partner A contributes property, partner B contributes money, they start a partnership. They both have 50-50 ownership. Next, we have S corporation. So S corporations is a corporation that is also treated as a flow-through entity. S corporations are essentially a special form of corporation that's treated by tax laws as flow-through entities. They are incorporated under state law, much like a C corporation, but if so, they elect to be treated as a flow-through entity for tax purposes. So the reason why an S corporation is called as an S corporation is because it is governed by subchapter S of the Internal Revenue Code. So sometimes S corporations have been referred to as a hybrid. It's essentially a combination of a corporation that's being taxed like a partnership. So although, the statement is partially true, there are some important differences. So when it comes to an S corporation, there's a limitation to the number of shareholders, and there are limits to the allocation of income and losses. S corporations report income and deductions on Form 1120S. The allocation of income and deductions are reported to the shareholder on Form K1. The shareholders' basis in the S corporation stock is calculated similar to the partnership interest as we calculated previously. And the flow-through nature of income deductions and basis calculations ensure the single layer of taxation. Next, we have LLCs. So with LLCs, a limited liability company is a legal entity under the laws of all 50 states in the District of Columbia, and it's a very popular organizational form. So as we mentioned earlier, as a sole proprietorship, there's no legal documentation to start a sole proprietorship. But let's just say you have a restaurant and someone comes in and unfortunately they are allergic to peanuts. In the event that you are a sole proprietor, you do not have any liability protection. You and the business are essentially one. So let's say, God forbid, this individual dies, from the allergic reaction. In the event that the sole proprietorship does not have enough money, they can now come after your personal assets as the business owner in order to, pay out lawyer fees, hospital fees, whatever it is, death benefits, whatever it is to this individual. However, as an LLC, there is limited liability in such case. So therefore, they can only come after the business. They cannot come after you personally if you have an LLC. There is, however, something called piercing the corporate veil. So if an individual has an LLC, but they are commingling funds, they are using the business funds to pay for personal things, and there's no clear distinction, there is something called piercing the corporate veil. So just keep that in mind. Oftentimes persons, they're not aware of this fact, and there are cases where persons have been held personally liable for things that take place in the business because they did not treat it separately as a business. But assuming you do treat it like a separate business, LLCs can be treated like a partnership for tax purposes, but they offer liability protection of a corporation. LLC owners are referred to as members, and they elect whether the LLC is to be taxed as a partnership, as a corporation. So as mentioned with LLCs, we have a single member LLC or we have a multi-member LLC. The partnership treatment is usually selected since there will only be one layer of tax on the income. LLCs that elect partnership treatment file Form 1065. If they elect tax treatment as a corporation, then they will file Form 1120. Single member LLCs are disregarded for tax purpose. So as mentioned earlier, the income deductions flow through to the individual's Schedule C. Next, we have LLPs, and LLPs, they're similar to LLC, except the partners are not liable for bad acts of the other partners. So that's one of the main things. So if you let's say a group of doctors decide to come together, a group of dentists to come together, they would form an LLP, so that way they're not liable for the bad acts of each other. Next, we have trusts. So trusts are somewhat of a hybrid entity in that they may either be a tax-paying entity or they might be a flow-through entity. So there's a number of different types of trusts. So just keep in mind, this discussion here is just very general, basic in nature, but trusts, they're typically subjected to income taxation on all of the net income that is not distributed to the beneficiaries. So the portion of net income that is distributed to the beneficiaries, then that amount is taxed to the beneficiary. So they file using Form 1041, and the trust marginal tax rates go to the highest levels far more quickly than on an individual level. So one of the disadvantages of using trusts is that the income tax rates are extremely progressive. So they reach the 37% bracket when the taxable income of the trust reaches $14,450. So you definitely want to ensure that if you are setting up a trust, because sometimes, there's a lot of information that goes around on social media, like set up a trust, get a trust. But again, trusts are taxed on income that's not distributed to the beneficiary. So it might not necessarily, depending on, how much income is in a trust, it might not work out in your favor, because if the income is not distributed, then it is being subjected to taxes, and it can be as high as 37%. So tax law, there's a lot of questions, right? There's a lot of nuance as it relates to taxes. So the solution to any tax question can only be resolved by reference to tax law sources. So an individual might have questions as it relates to tax-paying entities, as it relates to flow-through entities and things of that nature. Any question, the solution can only be resolved by reference to the tax law sources, and that they're also referred to as tax law authority. So tax law sources are generated from all three branches of federal government. We have the legislative, the executive, and the judicial branch. So the principal sources of tax law are as follows. Under the legislative, we have the Internal Revenue Code, which is Title 26. We have congressional committee reports. Under the executive branch, we have Treasury regulations, revenue rulings, revenue procedures, and private letter rulings. Under the judicial, we have court decisions and we have judicial doctrines. So having a thorough knowledge of the various sources above is very important to tax professionals, because keep in mind, there's a vast volume of tax law that's available to find an answer to a question. So you need to be able to recognize the fundamental importance of these tax law sources. And you also need to be able to evaluate the weight. The importance of the different sources of authority is also just as crucial. So for example, let's say there's a decision of the US Supreme Court on a tax matter, it would have more weight compared to a revenue ruling, something that was issued by the IRS. And last point for this slide is that the most authoritative source of the tax law is the Internal Revenue Code, which is passed by Congress. So as it relates to the enactment of tax law, under the US Constitution, the House of Representatives is responsible for initiating new tax legislation. Oftentimes when there's a new president that comes into office, people say things like, or they think that the president can just make a law, and because he's the president, then it stands. It's not true, right? There's a process in order for tax law to be enacted. So tax bills, they can also originate in the Senate, and oftentimes major tax proposals are initiated by the president and accompanied by a Treasury Department study or maybe a proposal, and then it's introduced into Congress. But again, it's not just that the president says one thing and it goes, there's a process. So the steps go as follows. You start off with a tax bill. It's either it is approved or it is rejected. There's a tax bill. If it's approved, then it is debated by the House. If it is rejected, then the House Ways and Means Committees holds a hearing with the public, the Treasury Secretary, and the IRS Commissioner. And if it's rejected, then the bill dies. Nothing happens. But if the tax bill is accepted by the House and Ways and Means Committee, and it is debated by the House and approved, then it needs to be approved by the Senate Finance Committee. They hold hearings. If it's rejected, the bill dies. If it's approved, it goes to the Senate. If it's rejected by the Senate, it dies. If it's approved, then they essentially have to now resolve any differences between the House and the Senate versions, and that is resolved by the conference committee. Then from there, they have a reconciled revision that's sent to the House and the Senate. If they agree, then it goes to the president, and the president either signs it and it becomes law, or if the president decides to veto it, then it's voted on by the House and the Senate. And in order for it to, become law, then it has to receive a 2 out of 3 vote. And then it becomes law. So again, the key thing with this is just to understand that when tax laws are enacted, it does not just happen overnight. So organization of the IRS. So it's very important to understand the administration of tax law and any issues within the practice. So the IRS is a branch of the Treasury Department that is responsible for administering the federal tax law. It is organized on a type of taxpayer basis, which allows the IRS to become more specialized. So as a tax professional, if I need to speak with someone from the business department, there's a specific line. If I need to speak with someone regarding individual taxes, there's an individual line. There's even separate lines for sales tax, for international tax, and things of that nature. So as mentioned, it allows the IRS to become more specialized. So the responsibilities and functions of the various administrative branches include the following. So we have the Treasury Department, we have the IRS, we have the IRS Commissioner National Office, we have the Operations Support Services and Enforcement, the Tax Service Centers, and then there's also auditors. And if you want to gain some better understanding of these various departments, you can feel free to refer to the textbook. And as it relates to audits, right? So all tax returns are initially checked for mathematical accuracy and items that are clearly erroneous. So let's just say you have a W-2 and on your W-2, it shows there's $55,000 of income. However, you reported $50,000 of income. This is an erroneous act. So therefore it can be picked up. However, the US tax system is also based on self-assessment and voluntary compliance. However, enforcement by the IRS is essential to maintain the integrity of the tax system. So the IRS uses both computers as well as experienced personnel to select returns for examination. With respect to use of the computer, there's something called DIF, and this is a discriminant function system, and is used to classify returns to be selected for an audit. So with the DIF system, a tax return generates a score based on the potential for the return to generate additional tax revenue. So after the returns are scored, then they basically manually screen them, and then they determine whether or not the return is going to be audited. So audits of most individuals are handled through an office audit procedure in an office of the IRS. And then sometimes you get correspondence or letter audits. So an automated letter is sent to the taxpayer if the reporting documents the 1099, the W-2, if it doesn't match up with the tax return, then the IRS requests money or they'll request explanation from the taxpayer. So less than 1% of tax returns are selected for audit based on the DIF score. There's in-person audits. Taxpayers will work with the IRS agents, either at an IRS office or at a taxpayer's place of business. And there's also the statute of limitations. So most taxpayers, they'll feel a sense of relief after they prepared their tax return and they mail it to the IRS, or if they've electronically filed and they accepted it. But you have to keep in mind, just because you filed a tax return, it does not necessarily end the story for that tax year. Sometimes it's possible that the IRS might select the tax return for audit after the return was initially processed, and the taxpayer may have received a refund, right? So both the IRS and taxpayers, they can make corrections to a return after it's been originally filed. So statute of limitations, absent fraud. So the IRS can audit a return for the later of 3 years from the date the return was filed or the due date. The longer statute of limitations is if there's fraud or if the understatement is more than 25% of gross income. Unfortunately, there is no limitation. The IRS can audit that tax return from 10, 15, 20 years ago if they see that fraud took place or there was an understatement of more than 25% of gross income. Next, we have penalties. So unfortunately, there's more than 150 penalties that can be imposed on taxpayers. And unfortunately, applying these penalties has become so complicated that the IRS, they're considering ways to consolidate and hopefully simplify them. So we have what's called failure to file. We have an accuracy penalty, a failure to pay penalty. And we also have fraud penalties. So as it relates to penalties, there's various non-deductible penalties that are imposed on the net tax due for failure to comply. And this applies to a failure to file return. So there's a penalty of 5% per month or fraction thereof that's subjected to a maximum of 25% for the failure to file a tax return if there's a balance due. For the failure to pay, This is a penalty of 0.5%, 0.5% per month, or the fraction thereof, up to a maximum of 25% for a failure to pay tax that is due. There's an accuracy-related penalty of 20% of the underpayment of items, whether there's negligence or disregard of rules or regulation. So that accuracy penalty is 20%. And for fraud, there's a penalty of 75%. So as we see, the penalties can be very hefty. So as it relates to interest and penalties, there are assessed on tax liabilities that were not timely paid. And this is just going over what I mentioned earlier. Failure to file is 5% per month to a maximum of 25%. Failure to pay is 0.5% of 1%, so 0.05% per month, up to 25% of the unpaid liability. Interest accrues on unpaid liability and the penalty. And please keep in mind that they accrue daily. The accuracy-related penalty is 20%, 75% penalty for fraud. In the event that any of these interest or penalties are assessed, then a taxpayer can decide to appeal to the IRS if the field or office audit results in an unsatisfactory conclusion. So this brings us to the end of chapter 1, which deals with an introduction to taxation. There's a lot that we covered. We covered the history of taxation in the United States of America, the different types of tax rate structures, the other types of taxes, some of the criteria for a good tax structure. We covered tax paying and flow-throwing entities in the federal income tax system, the tax laws, how tax laws are enacted, the administrative tax law and tax practices, what are some of the components of a tax practice. We also discussed the computer applications in tax practice. So I know that there's a lot of information to cover in this chapter, but I hope that this PowerPoint helped, gives you a greater understanding of an introduction to taxation.